Welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund in association with Value Research. Today we'll be talking about systematic investment plans, SIPs as they are popularly known. They're really gaining momentum amongst the investors. 5,500 crore worth of investment is done every month. Are they good for you? Is there unfounded trust in SIPs? Or they're really good? We'll discuss all this in today's Investors Hangout. With me is the CEO of Value Research, Dhirendra Kumar. And my name is Rajesh Lake. Welcome, Dhirendra.
Thank you.
So, systematic investment plan, SIPs. The investors are adopting the SIP way these days. What do you think about it? Do you recommend it? Not recommend it? What is it?
Oh, you know, it's not a matter of recommendation. We have, at Value Research, we have been the oldest, believers in SIP. We have been recommending investors that this should be the default way of investing in any market-linked investment. Uh, and the reason why they actually fit in everybody's framework is that you earn every month. We
Right.
work on a monthly cycle.
Correct.
We pay our bills every month. We pay our EMIs every month. And so we should invest every month. Maybe we should invest ahead of spending. So it fits in with our spending pattern or our earning cycle for most of us. Then comes, most Indians historically have been fixed income investors. They are used to, being assured of a return, howsoever low, or even if it is decent but low, people are comfortable. So for them, experiencing something which goes down in value, howsoever good it be, but if it goes down in value even temporarily, investors are very, savers are very difficult, find it very difficult to reconcile with that decline. You have invested, investing for the long run.
Right.
In the interim, your 15,000 rupees accumulated over 6 months period, even if you are doing 2,500 rupees SIP, if you realize that this 15,000 rupee as of now is 14,800 rupee, you will be extremely upset. But if you invest at one go, if you have 15,000 rupee and if it happens in few days time, you are even more upset. So averaging your investment, I think it's the only way, for investors to reduce the risk of investment. There are three things which is important, which is crucial, and it should be followed at all times, which is you are investing your long-term money in markets, you are investing through SIP, and you are investing in a vehicle which is diversified. Because if you if you invest in few stocks and even if you do it monthly, it won't work. So that diversification, averaging your investments, and making sure that you are investing your money which you are unlikely to need for 5 years and more. These three things. So SIP should be the default way for investors to get started. Otherwise, howsoever good you may be at investing, managing your own psychology will be extremely difficult, and so everybody should do it.
Okay. This investor psychology that you just mentioned, you get anchored to a market level. Would you like to elaborate a bit more on that?
Yes, investor psychology, investors think in a herd mentality, and it is not, and it is not easy to change that. Investors get excited about investments when investments have done well in recent past. If you see your neighbors or your friends making money, then you get excited about it. When the market is depressed, when the market has gone down in value, when you come across all the horror news that he lost money, that is a time when you are scared, and that is perhaps a good time to invest. But it's very hard for an investor to really work in a, think in that counterintuitive way. So the only way to deal with it is, and so you can't perfectly time the market. You don't know how that depressed period of that market will be. You also don't know how the exciting phase of the market will be. So the only way around it is follow a methodical investment plan. You will be able to average it. You will not be perfect. But and then for SIP investors, actually a market downturn turns out to be a little exciting. You feel happy that market has gone down and you will be buying cheap. Otherwise, if you were a lump sum investor and if you see the market going down, because to make money in the market, it's important not to be perfect with your timing. Of course, if you can do it, fine. But I haven't come across any fund manager doing it perfectly, so I don't expect an individual investor to be doing it. But so the way to be there, and most of the money is made in the market by remaining invested, because big moves in the market comes with a surprise. You know, when you least expect it, markets move. When you have given up on the market goes up sharply. When you think that the market cannot go down, then it corrects, then it goes down substantially. So to benefit from that, SIP is the only way. And psychology is very much against us, because the decline in value which you see in a brief period shakes you up, and it drives you out of the market, and you are deprived of this market, this great thing which, a market linked investment, equity markets in general, in a methodical way you can benefit from. You are deprived of that.
Okay, moving on. You just mentioned that when you invest through SIPs, there's a probability that you will not lose money.
Yes, what happens is
I
that,
mean, my antennas got up.
yes, it has actually turned out to be, a lot of people think that if you do SIP, then positive returns is your birthright.
Guaranteed.
And guaranteed, because you have done everything right. You are investing in market.
True.
You are averaging it. You are investing in a diversified vehicle. So how can you lose money? You can still lose money in the interim. I'm still hopeful that if you do your SIP on any 5-year basis, 6-year basis, you are unlikely to lose money. Not only you are unlikely to lose money, you are likely to make more return, generate more return than fixed income, because that is something which is, your risk-free return. You do nothing, you don't look for any fund, just go to your friendly neighborhood post office or a bank and start your recurring deposit. So
Correct.
that is the return which everybody should expect. But if you are aspiring for a higher return and you are willing to withstand these ups and downs, then you are taking some risk, and this risk gets reduced only with time. So if you start investing today and next 6 months market goes down steadily, you will lose money. You lose money on SIP on another count. Think of, we always keep encouraging people that even if you have lump sum money, if you have 3 lakh rupees, don't invest at one go. Average it over the next 12 months at least. And that averaging, you should follow a principle, how important that money is, and what is that money excuse me, that money, what is the what percentage it is of your total net worth, because depending on that importance of that money, you behave differently. So on these two count, I think that investors behave in a fairly erratic way, and so you have to average it. You have to, but investors have started believing that if you do SIP, you are done, you are taken care of, nothing can go wrong. No, it can go wrong in the interim.
So that was my
And
question then. If it is so good, then why shouldn't we carry on with this? Is there a problem associated with SIPs?
Yes, there is a problem associated with the SIP and the way the myth is actually gaining popularity. That if you do SIP, you can't lose money. So if an investor in the interim sees that his investment value is lower than his worth of investment, excuse me, the cost of investment, then it's a problem. He'll be disappointed.
So SIPs have three major advantages. Suitability, that means you earn monthly, you save monthly, so you invest monthly. The other thing is about rupee cost averaging. And the third thing, which we delved deeper, was about investor psychology. You don't get anchored to a market level. And these are the three reasons why you should need to do
Yeah,
SIP.
one point which I was not able to elaborate on is I would like to one point which I would like to elaborate is that investors, we always encourage investors to invest even their lump sum money over a period of time, average their investment, and in that case there is a loss, because if market is steadily going up, you could have bought cheaper, but the market went up. But mind you, this is an opportunity loss. Many a times investors complain that they should have invested lump sum. So SIP is nothing but a great tool to actually form a habit, manage your psychology,
Correct.
align it with your income cycle, and these investments. I think these investment habit is for a lifetime, and 1 year, 2 year, or 3 year of underperformance, or 2008 happening in the interim, or few weeks, few months being disappointed about this investment is not the issue. The issue is that you develop a plan, it works for you, and then if you are able to stick to it for a lifetime, then it turns out to be extremely rewarding. And it is that kind of belief because of which investors can benefit from the markets. So you have to form a belief in the method that you are following and stick to it.
So therefore, what I deduce out of this is the problem is not with SIPs,
Yeah.
it is with the expectation from SIPs.
Absolutely.
Okay, so if I'm an investor, what should I be doing? If I'm a SIP investor, what should I take care of? You did mention that long term is important, be regular in your investment. What else?
Do nothing. In fact, doing nothing actually works in most cases. Of course, what you should be doing is that most of the time we'll think of SIP as a constant money, that we are investing 5,000 rupee a month. All the calculators, all the online tools, they talk about 5,000 rupees a month if invested for last 15 years or next 15 years at this much percentage, how much it will translate into. That is not real life. Real life is that sometimes you lose your job, and most of the time you get increment, your income grows, and in that sense revise your SIP amount. Be methodical about it. You have absolutely no control on the state of the market, but you have a full control on what you do with your money, what you do with and how you behave, how you conduct. So you start with 5,000 rupee. Make sure that if your income goes up by 10%, you are able to increase your investment by 10%. And if you keep uh, doing it for 5 years, I think you will see the results yourself.
Okay.
You will not have to listen to investors hangout to get a reinforcement in this idea.
Okay, so we talked about the myth also here that you cannot lose money in equities if you invest through SIPs. So that, according to Dhiren, is a major myth. And so continue to invest and do nothing, as you
Yes.
very
If
rightly
you're
said.
onto a SIP plan, make sure that you are revising your SIP amount every year, and you are doing it for at least 5 years before you do a review. And then I don't think you will need to do a review at all. I think the real returns or the realizability of that investment, and take a note of all the time in the interim when you would have got anxious, you would have thought that maybe you have not done the right thing, and take note of that, and any 5 year time period you will be pleasantly surprised, and it will prove to be hugely rewarding.
Then I, for one, when once I have invested, I forget. I take his mantra very seriously. I completely forget that it's gone.
Yep.
It's taken care of. Everything is gone. But are there any situations where we need to panic when it comes to SIP? Are there any market trends that we need to be watchful of so that
Yes, I think two cases, two situations when you should be watchful, but they are not actually market dependent. One is that you have chosen a fund, and that fund, when you started investing, it was a good fund, and over a period of time, 1 or 2 year, you find that it is not proving to be a good fund. You should review your position. The other situation is actually internal, that will vary for an investor to investor, that if your circumstances change, you thought of long term investing, you thought of investing for a long period, but then something happened which actually makes you think that you will be needing this money in a year's time, you'll be needing this money for an
right,
emergency,
right.
and it is your money. So when you have such situations, anything which actually prompts you to reconsider your long term orientation, or the investment has turned not so great as it was expected, in these two situations you have to reconsider. Otherwise, I don't think. And that first situation, that the fund is not proving to be good, that will arise after 2, 2, 3 years, because I don't think mutual fund should be evaluated on a brief time period.
You mentioned an unforeseen circumstance like one losing a job,
Yep.
for example. So, in that case, you need to bring down your SIP because you don't have the money to give.
Yes, there is also, a lot of times people think that, if you have actually given a SIP instruction, uh, then being a defaulter, you have given a authorization that a bank mandate that debit my account. All you have to do is cancel it if you are unable to make that investment, and it is not a it's not a violation of a contract. When you borrow money and your check bounces for your EMI payment, it's a problem. You have borrowed money. This is where you have chosen to invest. This is not a violation, but plan it. When you have to cancel your future SIPs, do it methodically. It can be done by informing the fund company and canceling the
The
bad
bank.
mandate if you have given if you have done it online.
Okay. So you heard about the advantages of being systematically invested in your various funds, etc. So make sure that you continue to do your SIPs diligently and as regularly as possible, unless, as Dhiren mentioned, something unforeseen happens.